In this week's market update, oil shock on the cards after Saudi attack, central bankers under the microscope with Carney looking the odd man out, and Brexit negotiations get difficult as Johnson pushes for a deal. The biggest news at the start of the week was the drone strike against Saudi Arabia's oil fields, which led to a 20% spike in the oil price. An Aramco facility and nearby oil fields were struck by a swarm of explosive drones on Saturday, causing half of Saudi oil production to cease. At time of writing, responsibility for the attack had not been established, although Iranian-backed rebels in Yemen claimed to have carried it out, and the US publicly blamed Iran. Clearly, there is a risk that wider violence and economic disruption will follow these events. Brent crude initially gained almost $12 a barrel to reach a price of $71.95 before falling back to a level around $67. Stock markets were generally holding steady after hearing the news, with the FTSE 100 trading around 7,360 and hanging on to gains made last week. Given the news for oil, it was no surprise to see BP and Shell at the top of the leaderboard on Monday, each adding around 3% in morning trading. The S&P 500, Euro Stoxx 50 and Nikkei also rose last week. In bond markets, sovereign debt has seen a recent sell-off, with a corresponding fall in government bond yields after decent news on US consumer spending and a softening of rhetoric between the US and China on trade. That was in contrast to news in Europe last week, where fears about a slowdown prompted the European Central Bank to announce a fresh stimulus package with an interest rate cut and plans to pump 20 billion euros a month into financial markets. Outgoing ECB President Mario Draghi said that the emphasis was now on governments to up their spending as a means to kickstart growth, suggesting that there were limits on what monetary policy could achieve. The ECB had an unlikely cheerleader for its loosening of policy when US President Donald Trump applauded the move via Twitter, then poured pressure on Jerome Powell and the US Federal Reserve to follow the same rate-cutting path. The president will get some of his way at least this week when the Fed meets to set rates. A quarter-point cut in rates is expected, following the same size reduction at the last Fed meeting. But the real question will be whether that's all we get this year. The Fed has moved less quickly in cutting rates than some economists and the president would wish. News of a potential oil shock then only complicates the picture more. On the one hand, it raises costs for businesses and individuals who see prices rise, and that hurts growth, but it also puts upward pressure on inflation, which a lower Fed rate will amplify. Much attention on Wednesday then will be on any accompanying comments from the Fed about whether there will now be a pause in rate reductions. The Fed will be followed on Thursday by the Bank of England, which is not expected to lower rates. It will, however, face the same questions as other central banks about a slowing global economy and its response to it. The bank has found itself out of step with other central banks, still insisting the next move for rates is likely to be upwards. That stance has been hard to square, though, with worsening UK economic data and a slip into negative growth in the second quarter of 2019. Those conditions would normally suggest that a loosening rather than a tightening of rates was the next move. Further informing the bank's decision will be the inflation data for the UK, which arrives on Wednesday. Once again, it will be the commentary that accompanies the rate decision that will be of most interest, in particular for clues as to whether the UK can avoid a full-blown recession. That depends in great part on Brexit and whether the UK can avoid crashing out of the EU without a deal. Prime Minister Boris Johnson begins this week in Luxembourg, where he met EU President Jean-Claude Juncker. The pair discussed whether agreement can be found on Northern Ireland in particular. The UK wants any backstop arrangement to be more limited than that proposed by the EU. This is the mechanism which means the whole of the UK will stay aligned to EU customs rules so that there is no hard border on Ireland in the event that no other border solution can be come to. The UK wants to limit alignment to just Northern Ireland and just to food and agriculture. The EU, on the other hand, has so far been unwilling to separate these things from other trade. Even if a deal were to emerge, there is still a big question as to whether the Prime Minister could sell that deal to enough MPs to pass a Commons vote. If no deal is agreed, the Prime Minister is bound by law to ask for an extension, but he's repeatedly said that he will seek to escape doing this, possibly through a legal challenge. There may be more news on that this week when the Supreme Court in London decides whether the Prime Minister's prorogation of Parliament or the closure of Parliament was lawful or not. The executive has said that it will wait until that legal decision is made before it makes its next move on avoiding a no-deal extension. That's it for now. Have a great week.